I'm Craig Fuller here with JP Hampstead. JP, it is fall.
It's fall, and you're wearing pink.
I am pink.
What's up with that?
Well, it's Breast Cancer Awareness Month, and in spirit of that, I am wearing pink.
Cool. It's cool to see the FreightWaves logo on a bright cheer. It's still like a fall pink, though.
It is we've had debates about whether
pink.
This is the only pink Peter Millar makes.
Okay.
In this particular design, so that's why it. There's been debates about whether this is salmon. Somebody call it cranberry, raspberry. I call it pink.
Interesting. Yeah, no, I like it. Cool.
So so let's talk about rates, trucking data.
Yeah. So trucking data, it's been interesting. I mean, we talk about volumes as kind of the first thing that hits the market, right? And they're up about 6.1% year over year still. Now, I think the thing to keep in mind, though, is that last October is really when volumes fell apart. That's what sparked off this 10-month-long freight recession that we talked about.
Yep.
So the year-over-year number kind of makes the volume story look better than it really is. They're kind of stagnating.
Just because year-over-year, the market's just going sideways.
Yeah.
I'm hearing from some of the larger asset carriers is that volumes are certainly up. A normal season is what they would describe it. Everybody still compares it to last year, but there's no point in doing that because at this point, 2018 is written off as an exceptional year.
Right. And if you look at the forward curves, people are still pretty uncertain about what next year. I mean, they track, the forward curves for trucking spot rates kind of track what 2019 has looked like.
Mm-hmm.
Peak in July looks similar to this.
But it's a normal
July.
year. I mean, the only thing I would say is if you look at the actual slope of the chart, it looks more like 2016 than it does 17 and 18. It's at least compared in terms of rate. So we saw it bottom. We saw the rates really. August was sort of the bottom of the market. It's always that. It's sort of trailed up, but it hasn't accelerated like you would hope to see this time of year.
And there hasn't really been the outperformance from the demand side, from the volume side that would have moved rates a lot. I mean, and some of the recent industrial production numbers, the industrial ISM and the services ISM that came out on Thursday are both, I think you can, so first of all, manufacturing went into contractionary territory. So majority of the survey respondents said that they thought that their activity was going to be less instead of more. You can debate whether how much of that was caused by the 3-week-long GM auto worker strike that obviously took a big bite out of September, but the 6-month trend line is essentially straight down.
Well, it's down. The question I have is the volume shortage we saw in the summer.
Right.
Is this reverberating through the ISM number, or is there another slowdown in the market headed for trucking?
I think it's forward looking. I think this is a survey of people in the industry about where they expect their activity to be. Mm-hmm. So I think it's looking bad for volumes. I'm concerned about that.
You think volume's going to drop off a lot?
I think that outside of retail, so on Friday, we're going to get payrolls numbers, which can tell you, it's a pretty good indicator for consumer confidence and things like that. We all expect the retail performance to be pretty strong. I mean, honestly, in the economic cycle, the American consumer is the last one to really react. It takes a lot for people to spend less money than they did the year before.
Yeah, for sure.
Seth and I were actually looking at a chart of
retail
personal consumption.
Yeah.
And over the past 60 years, it literally only goes negative for a month or two.
Well,
even
and you had the
recession.
2008 recession, which was.
But it went negative for a month or two.
Right.
And then it just kept going.
Consumers, the American consumer will spend money.
Spend every dollar they have.
That's what we do.
It's
sort of an unfortunate reality of the culture we grew up in. It's a consumption culture. We've not had a catastrophic, and you have setbacks, but
right.
You look at the Chinese economy where they went through centuries of real tight conditions and famines, and that predisposes you to this view of anytime there's a pullback, is going to save a lot of money. That's when the Chinese frankly save. Culturally, they're more prone to saving money than spending.
They're biased for the downside. We're biased.
Well, they're very conservative.
Americans are eternally optimistic, right?
And I think that's part of the reason that the economy is constructed the way it is, and that's why the consumer has such an enormous impact on the freight market, because of the fact that, to your point, it's always growing and has structurally grown.
And even more, when we talk about the timing of an economic cycle, the consumption is the consumption indicators are lagging because it takes so much to spook the American consumer.
Yeah, exactly. I think as long as the employment picture stays strong, then the consumer will continue to spend money.
Right.
And that may keep, even if the industrial sector goes into a structural decline for some period of time, consumer may keep parts of the freight economy really strong. The good news is for much of the market is that there's a lot of stuff happening for the next couple of months in terms of freight activity. So anything that could happen in terms of shortage or manufacturing slowdown, we may be in a season where the market can absorb it.
That's right. And there is a lot of stuff going on, and I think sort of rate expectations are kind of around normal seasonality. People expect rates to go up, and they will, but we don't think it's going to be a kind of at least the brokers that I talk to don't think it's going to be like a systemic capacity shortage that really blows out.
There's no reason to think rates are going to go up tremendously, and we've talked a little bit about it. If you look at sort of bullishness, we're really bullish coming into what we saw in July and August, probably muted more as we sort of moved through the fall.
Yeah.
I would say I'm optimistic in volume. I think the market's going to be pretty good. I mean, housing has come back in force. New housing starts have done well. Oil has had some pressure due to geopolitical events. Autos are in cyclical decline, regardless of whether the GM's on strike or secular decline. It's just a market. We've already seen peak auto, and I think a lot of this is sort of a restructuring of the auto markets, and I think a lot to be said. I mean, agriculture also has an impact on freight. Things like right now in the Northwest, the apple market's moving. A lot of demand for things like pumpkin. This is the time of year where you see a lot of ag products move for the holidays, and they start to get them into the canneries, they start to get them in production facilities so they can be ready. We've seen the Pacific Northwest blow up because of that.
Definitely, and I think one of the hardest parts, though, to get a handle on, and it's always the hardest part, is capacity, right? And so we've seen trucking carrier failures continue. Had one last weekend. Carriers.
We don't know if it's a failure. They filed Chapter 11, which is a restructuring. It's
not necessarily removing capacity.
They could survive, and the question always is will the banks foreclose on the debt? Will the creditors foreclose? Frankly, I don't know the structure of the business and whether they're able to service any of their debt, but trucks against defense don't pay very well, so if they're able to get something out of it, they may.
Right.
So I wouldn't read into it that it's a complete shutdown. It is a bankruptcy, but it doesn't necessarily mean the carrier has left the industry.
Right, so those 300 odd trucks might still be on the road, but I think
all indications from what you've seen is that they're still under dispatch.
I know you worked on that story. Did you figure out why exactly they filed? Did they?
There's a private equity fund. It was refrigerated. Refrigerated's had a tough year because the ag markets have been off because of weather, and I think a lot of times private equity, you have an environment where they're making acquisitions, maybe at higher multiples. Oftentimes when you see roll-ups in these asset-based companies, it's how they buy the company has as much of an impact as how well it performs.
The price you pay, which in turn affects the debt load that's put on the company, which then affects essentially their cash flows.
Yeah, I mean, what I had heard, a source had said, is that the private equity fund behind it were not traditional trucking operators and didn't have a lot of bench depth in terms of how to operate it. But that was a comment made by a former associate of the company who I won't name.
So who knows?
But that was his observation of what happened.
Interesting. So a couple of sort of data points around capacity that are hard to kind of kind of get your head around is the fact that prices for 3-year-old trucks are positive year over year. They haven't really gone down. We've seen 4- and 5-year-old models go down 1% to 2%.
Well, fuel economy and driver recruiting. I mean, the driver employment picture is still tight. And so even, it's not as tight as it was last year, but it's still tight. And I think carriers desire those trucks that run better, have better fuel economy, as well as trucks that are newer because
So you think that...
Plus you got to remember that in some of those 4- and 5-year cycles, what you have is engines, the Cummins engine, the Navstar trucks and Cummins engine had a lot of issues. And that year for trucks was a bad year. So those 5-year cycles very well could have that overhang.
Okay, but in general, you think that in the used truck market, the demand is going to be stickiest on the newer models?
Always. I mean, demand, if you have a choice as a trucking company to buy a newer truck or an older truck, you're always going to pick the newer truck. Even if the delta between the two is... So those 3-year models will stay stronger than the 4 and 5s because carriers are looking at them for driver recruitment and fuel economy.
Does that tell us anything about who's buying? Like
it's hard to read that into it. I mean, certainly, there is a certain type of buyer that buys really older trucks, which tend to be the dray operators and cross-border movement where it's not over the road and you don't have as much of a competitive...
You're never that far away from your maintenance facilities.
Correct. And so you'll see older trucks, but when you get between 3 and 5, owner-operators tend to be a little bit later, but the fleets are still buying. Some of the fleets are still growing. So,
we do see new truck orders, on the other hand, have obviously there's a bit. The OEMs have a large backlog that they're still fulfilling from the record orders last year, the beginning of this year, but new truck orders now are trending at about 150,000 annualized, which Seth also did some work on.
It's what, half of what it was last year?
Yeah, and more importantly, it's below like what they consider like the normal replacement rate.
Yeah.
So I don't know if that means that...
Well, it's cyclical. I mean, look, at some point, the question will be the economy. The economy goes into a real retraction, then that cycle could go longer. If we have an economy like it is right now, even if it's sluggish, some of that capacity might have left. I mean, you got to remember, these bankruptcies don't mean that drivers are leaving the industry. Right. They mean that operator has left the industry, but that operator, the drivers that work for the truck companies may recycle throughout. They may start their own company.
Yeah.
We don't know those facts. I mean, the truck count is the more important fact to look at, not the companies that gone under, because those jobs end up being recycled. They could very well walk up to another trucking company and get a job the next day. There's nothing to prevent that. One thing I want to ask you is your outlook in the fourth quarter. Are we going to see real strong rate conditions, or do we think it's going to be pretty sluggish?
I think that if you look at the forward curve, you talk to brokers, you talk to shippers, who, well, at least you talk to carriers who say that their conversations with their customers, they're still planning. They're trying to lock up capacity for the fourth quarter. They're planning for a lot of volume. I think that I recently covered something that Salesforce released about their holiday retail e-commerce forecast, which they're very bullish on. They have tons of both consumer and sales data. So I think that I think that across the industry, everyone expects rates to go up. So I think that they
you saw it in June where there was no real reason they went up other than market psychology and
exactly.
Sentiment.
So I think seasonality and psychology has at least primed the pump, and as long as people are spending money, then I do think we'll
now
see
the last thing I want to ask you is, do you, in your view, I heard this from an executive of a large enterprise carrier, that the digital brokers are starting to keep their belief is the reason we're not seeing spot rates go up is because they think digital brokers are gaining share and keeping rates low. Do you buy that?
No.
You don't think that they're actually a factor in the market?
I don't think that they're big enough to move prices. Not really.
I mean, it's really, remember, it's that it's not move it for the whole market. Even if the 3%, it's that incremental load that matters.
Yeah, it's certain lanes, they might be more dense in it, but I think really where they undercut prices is to the shipper.
That's what I'm saying, but is it
not
keeping...
on the spot.
Right,
not
but
on the
is it
spot,
keeping some of that pricing capability out? I don't personally subscribe to that. That was something I heard this week.
I mean, it's interesting. I don't necessarily think that Uber Freight or Convoy or Transfix or anyone else has the power to move the market, but
not
to the
in
extent,
by himself.
But what they can do is, they can go after. We know they're going after the large enterprise customers because that makes the most sense. They need a lot of volume,
high volume
networks.
shippers, yeah.
So they're coming in very aggressively. That everyone else who also wants to do business with those
they know that those guys are there.
Have to follow the leader.
Yeah.
So could they be?
Is it race for the bottom? Race for the bottom?
I mean, I've definitely heard people say that. I don't know how. Yeah.
We haven't seen any data suggest that yet. We'll see.
Right.
Report that JB Hunt 360's margins or brokerage margins won't see the level of margin they have historically. Was a report that came out today.
Yeah.
Or yesterday. So we'll see what that looks like. But
yeah,
a lot of stuff to watch.
I found that interesting.
Certainly something to watch. I mean, look, they're still operating at 12, 13% margins, which, frankly, from what we understand about Silicon Valley brokers, these are really compelling margins.
Yeah, and that's where the digital, the native digitals want to get to.
Yeah.
They'd be thrilled to get to that.
Yeah, absolutely.
So I think definitely, I mean, I think it's going to be really fascinating, honestly, just to see how Q4 plays out, to see where the volumes are and what rates do.
We're going to dive into that. Are you signed up for FreightWaves Live?
Yes.
FreightWaves Live on November 12th and 13th. We're going to dive into this topic as well as others as we do every single week on the weekly rate update. JP, one of the things that we're going to talk about there is a debate about what is the best logistics city. Is Chicago or Chattanooga the best place to build a logistics company? What do you think?
I mean, I think it's Chattanooga.
You're going to make the case.
I think, honestly, and the reason I say that is not necessarily because of per capita, because of absolute volumes or revenues. I really like the community.
Because you're here.
I like the community. I've heard that a lot of the companies in Chattanooga are pretty cutthroat, pretty sharp competitors with each other, don't necessarily like each other.
You mean in Chattanooga or Chicago?
Sorry, in Chicago.
Yeah.
In Chattanooga, on the other hand, it feels like an alumni network of,
it is a very tight community.
And people, even though they're playing for other teams, they keep in touch. They'll have a beer with each other. They'll come to the same spots. So I really think that's what makes it's indicative of Chattanooga, and I think it makes it a great.
Are you going to be on the debate stage?
Am I? I don't know.
We're going to talk about that. Certainly, Matt Silver has challenged me. He says that Chicago is the greatest logistics city. What do you think? Going to find out at FreightWaves Live who's going to win the great debate. We actually have a neutral moderator, which we're going to reveal who that is.
But Silver's got home court advantage.
Folks in Chicago, Silver has home court advantage, but it's at our conference, so we have the advantage there. So we'll see. Chattanooga versus Chicago. Who's going to win? Find out at FreightWaves live on stage, November 12th, 13th, the great debate. We will see you there.
Our industry is moving faster than ever. Where are freight volumes headed? How will this affect capacity? And of course, what's the newest technology that can benefit your business? Those questions and many more will be answered at the industry's hottest Freight Tech Conference this November in Chicago. Come join us at FreightWaves Live, November 12th and 13th at the McCormick Center. Visit FreightWavesLive.com to register.